Welcome back. This is the continuation of the practice problems. Okay, now next problem. Angela purchased the stock for $100,000, same as before, but it went down in value. And so now she's selling the stock to Barbara for $75,000. Okay, income tax consequences? Right, of course. There are two rules in section 1001A. There's the gain rule that we've been working with on the top half there, but then there's also the loss rule. The loss shall be the excess of the adjusted basis provided in such section for determining loss over the amount realized. So remember, excess over means subtract, but don't go below 0. And section 1001A says the gain is excess of amount realized over adjusted basis for gain, and loss is excess of adjusted basis adjusted basis for determining loss over amount realized. So we have two formulas, and in some cases we'll have two different bases. Okay, here are the two formulas. So I've changed them a little bit to show that we're talking about the adjusted basis for determining gain or for loss, because sometimes we have two different basis numbers for one asset. Okay, back to our problem. Angela bought the stock for $100,000 and she's selling it when it's worth $75,000, and she's selling it to Barbara. So Angela's basis is $100,000. Her amount realized is $75,000, so she has a loss of $25,000. Barbara just made a purchase for $75,000, so she has a cost basis of $75,000. And a cost basis, there is only one number. It's the same for determining gain or loss, so she only has one basis number to worry about. She sells the stock for $50,000. Well, she purchased it for $75,000. That's the basis for determining gain or loss, and so in this case she has a loss of $25,000. Now, what if Barbara sells the stock for $125,000? Well, she still has a cost basis of $75,000. That's a cost basis, so there's only one number for determining gain or loss. And so our formula, amount realized minus adjusted basis, gives us a gain of $50,000. What if Barbara sells the stock for $80,000? Okay, I'm getting tired of this problem. Barbara's basis is a cost basis of $75,000. It's the same whether we're determining gain or loss. And so in this case, it's a little gain, $80,000 amount realized minus $75,000 basis. Yes? Okay. So notice that in all of these examples where Barbara purchased the stock, we stopped caring about Angela's basis. Right? We just looked back to how much did Barbara pay for the stock. We figured out its cost basis. So a cost basis really means that we're starting over with this asset. Now, to change this up, Barbara will give the stock, or Angela gives the stock to Barbara when it is worth only $75,000. Right? This is the stock that she purchased for $100,000. It has gone down in value, and now the fair market value is less than her basis. In this instance, Barbara gets two different bases. She gets a basis for determining gain, which is Angela's basis, and she gets a basis for determining loss, which is the fair market value at the time of the gift. Only if that is lower than donor's basis. That's the only time this rule kicks in. So now Barbara sells the stock for $50,000. So remember that Barbara has two different basis numbers, one for gain and one for loss. This looks like a loss, so we'll use the $75,000 basis, and the amount realized is $50,000, and that means that she has a loss of $25,000. Now, what if Barbara sells the stock for $125,000? Remember, she's got those two different basis numbers. This looks like a gain, so we will use the donor's basis of $100,000, and she has a gain of $25,000. Okay, and here's that third scenario. Barbara sells the stock for $80,000. Okay, now this is where having two different formulas comes in really handy. It's kind of hard to figure out whether this is going to be a gain or a loss because the number is in between the donor's basis and that lower fair market value at the time of the gift. So we'll just do both formulas. Okay, so we'll determine gain first, amount realized minus adjusted basis for gain. So that's 80,000 amount realized minus 100,000. Oh, can't do that. That would be a negative number. So we only go to 0. 0 means that there's no excess. So that's the beauty of these excess over formulas. Either there is an excess or there's not. So here there's no excess, so no gain. Okay, go on to the loss formula. Loss formula, adjusted basis for loss minus amount realized. Or in other words, the excess of adjusted basis for loss over amount realized. So 75,000 minus 80,000. Oops, that would be a low number too. That would be a negative number. Can't have negative numbers. So no excess means 0 loss. So there's no gain and there's no loss, right? If Barbara sells anywhere in that kind of that no man's land between 100,000 and 75,000, she will have no gain and no loss. Okay, now what is that about? Well, when property has depreciated, has gone down in value, if we sell it, that loss can turn into a deduction, which is nice. But deductions are more valuable to some people than to others. They're more valuable if income is in a higher bracket, and they are more valuable if you have enough income to deduct them from. So it would be pretty tempting to just give the property to a close friend who can actually use the deduction, and then, maybe we split the tax savings or something. We don't want to let you do that. Can't choose who gets to have the deductions. No handing around the deductions. So that's what this rule prevents. You can deduct only that part that happens while you own the property. Okay, now, shifting gears a little bit. We've been talking about property received as a gift. What about inherited property? There's a different basis rule for property received from a decedent, and it's very straightforward. Section 1014 says if you receive property from a decedent, the basis is the fair market value at the time of death. That's it. Doesn't matter for gain, for loss, for anything. Fair market value at the time of the gift. Okay? So Angela purchases stock for $50,000, and then a few years later, when it's worth $200,000, she dies. Leaves the stock to Barbara. Barbara's basis is $200,000, the fair market value at the time of the gift. We don't care what Angela's basis was. Notice, well, we'll get to this. Okay, so now if Barbara turns around and sells the stock, that's the number she uses for basis. She uses $200,000 fair market value at the time of the gift. And so if she sells for $300,000, she only has $100,000 of gain. If she sells for $50,000, she still uses, or if she sells for $125,000, she still uses that $200,000 basis, the fair market value at the time of death, and so she would have a $75,000 loss, even though $125,000 is more than Angela's basis. We don't care about Angela's basis. It doesn't matter that nobody paid tax on that increase in value while Angela owned the property. Remember, Angela bought it for $50,000 and it went up to $200,000. This is a pure loophole. Section 1014 provides a step up in basis at death, or it could be a step down, but it's a step to fair market value with no tax consequences. So that gain can escape taxation altogether. All you have to do is hold on to it until death arrives. And I think that's the end of this video. Thank you for watching.